Hey guys, welcome to Trade Like Assad. The smart money trading method works by tracking the movements of institutional capital placed in the market by financial experts and aligning our trades with them in the same direction. In this episode, we are going to reveal a complete advanced smart money trading approach that will truly amaze you. We call this method the order block strategy, or order block. If mastering advanced trading concepts, techniques, entry setups, and maintaining discipline through a trading plan excites you, then make sure to subscribe to our YouTube channel and check out our videos. See you right after the intro. Before we begin explaining the strategy, you must understand a few smart money concepts such as order block, break of structure, and change of character. Now, let's give a quick explanation. Let's start with order blocks. Order blocks are refined demand and supply zones, created when a significant amount of capital flows into the market, causing a strong price movement. In other words, they appear when there is an imbalance between buyers and sellers. Here's how we identify order blocks. In a bullish scenario, the final bearish candlestick before the start of a strong bullish rally is marked as the order block zone, or it can also be the first small bullish candlestick before the major move. The same principle applies in the bearish scenario. Now, let's move on to the concepts of break of structure and change of character. Imagine a trending market with a sequence of higher highs and higher lows. In this case, each high and low represents a market structure level, and the most recent higher high and higher low are the ones we closely observe. Breaking the latest higher high to the upside signals that the market aims to continue upward, which we call a break of structure. Conversely, if the market breaks the recent higher low to the downside, it shows that the market intends to reverse direction, which we define as a change of character. The important detail is that a break of structure is valid even if only a shadow extends above the previous structure level. However, for a change of character, we specifically require a candlestick to break and close below the prior market structure. Now that we've covered the smart money concepts, let's dive into one of its most effective strategies. This strategy has two main steps. First, we analyze the market structure and identify order blocks on the higher time frame. Second, we zoom into a lower time frame, wait for a change of character to appear, and then search for order block entries. For example, if we have identified order blocks on the 4-hour chart, we look for entries on the 15-minute chart using the same approach. If the higher time frame is 1 hour, we search for entries on the 5-minute chart. Keep in mind, this strategy is not tied to any single time frame, but your entry time frame must always be at least 2 times lower than your analysis time frame. So, let me now explain the steps of this strategy directly on the candlestick chart. Look at this 4-hour chart of the New Zealand dollar, which is our higher time frame. In the first step, we analyze the market structure and highlight the most recent order blocks. Here, we have an uptrend with this latest move showing imbalance and a break of structure. Therefore, this level is an ideal order block zone that could potentially be rejected and provide us with a trading opportunity. Now, all we need to do is wait for the price to touch the order block zone. In the second step, we zoom into our entry time frame and look for trading setups. Since we are analyzing the market on the 4-hour chart, we now zoom into the 15-minute chart. Notice how, in the 15-minute time frame, the market is trending downward. So, in this step, we must wait for a change of character to appear. If no change of character occurs, then there will be no trade. In this case, for a change of character to happen, we need a candle to break and close above this area. This signals that we are no longer in a downtrend and that the market could potentially start moving upward. Next, we look for new order blocks to place our trades. In this scenario, this zone makes a perfect order block since it belongs to the move that created the change of character. Here's how we execute the trade. We place our order a spread size above the order block, with the stop loss a few pips below the lowest point of the zone. For the first take profit, you can close half of your position once the price reaches a 1 to 2 target. This way, even if the price pulls back and hits your stop loss, you remain at break even. For the second take profit, you can target the next market structure level on the higher time frame, or alternatively, you can trail your profit. That means, each time the market forms a higher low, you adjust your stop loss a few pips below the lowest candle. But that's not all. We can also look for additional entries as the market continues to move upward. Each time the market forms another order block, we could set a new order with reduced risk. For example, notice how the market creates another order block here, so we place a new order. Again, another order block forms, and we set another trade. However, this is optional, and you should never attempt it without thorough backtesting and building confidence. Also, remember that whatever position size you risk on the initial change of character order block, you should risk only half of that size for the subsequent trades. And never hold more than 3 trades at once for the same analysis on a pair. For example, if you have a small account and decide to risk 2% on the first trade, then risk 1% on the second and third trades. This way, in the worst case scenario, you lose only 4% of your capital, but in the best cases, you can earn significantly more, which is how you practice smart risk. I hope this explanation was clear and not confusing. If it was, don't worry, I'll show you more examples. Let's look at the euro-dollar on the 1-hour time frame. Here, we can immediately notice this impulsive move to the downside with imbalance and a boss, so we draw our order block. Now that the price has reached this level, let's zoom into the 5-minute time frame and search for entries. Here, we can see that a change of character has already formed, since the candles have broken and closed below this level. So, we mark this recent 5-minute order block and place our sell order. Now, notice how price created a new order block. Without cancelling our first trade, we place another one with reduced risk. Let's see what happens. The price moved back, hit the stop loss of the second trade, then triggered our first one and reached our target. In this scenario, you would lose a small percentage on the second trade while gaining a larger profit from the first one. This is a common situation when trading the smart money strategy, and you should not cancel your orders before the price reaches your target. Let's review another trade example on the Aussie dollar, which is slightly different from the earlier setup. Here, we see an impulsive move to the downside, so we mark our order block. Since this is the 4-hour time frame, we zoom into the 15-minute chart to search for potential short entries. On the 15-minute chart, a change of character has already formed, so it's time to identify a new order block and place short entries. But here's the issue. We want our stop loss protected above this swing high, yet we cannot identify any clear order blocks in this zone. So, how do we trade in situations like this? In such cases, we enter the market using retracement levels. We apply the Fibonacci retracement tool and place the sell order right in the middle of the 0.618 and 0.786 levels. This time, we allow for a wider stop loss, because we are entering as early sellers, and the swing high has only slightly touched the 4-hour order block. Typically, the market attempts to hunt the stop loss of early sellers. Okay guys, I hope you can integrate this strategy into your trading plan. But always remember, simply knowing the method is not enough. To execute it properly, you must test it across different currency pairs to identify the most suitable ones. Also, always maintain a solid risk management plan to stay protected during volatile days. That's it for this video. Thank you for watching. I hope you gained real value from this video. If you did, be sure to hit that like button. It really helps us out and shows us that you're enjoying the content. And if you're new here, consider subscribing for more trading strategies. Thanks for your time, stay disciplined, stay consistent, and I'll catch you in the next episode.